daily insights that matter. In this DITM, we will take a look at how the Indian economy has performed in the first 4 months of this fiscal year. We will also look at some macroeconomic indicators released yesterday to see where India is headed. The much-awaited Q1 GDP numbers are out. India's economy grew at the fastest pace in 4 quarters. However, it did trail RBI's forecast of 16.2%. Let's briefly discuss the details in Q1 GDP numbers. Q1 GDP came in at 13.5% as against a 20.1% growth seen during the same period last year. The double-digit growth was driven by a low base of the second wave of COVID-19 in Q1 fiscal year 22 and the revival in contact-intensive services. When we look at the breakup of Q1 numbers, growth in private consumption was faster than expected, growing 25.9% year over year, and the GDP growth was also boosted by the growth in gross fixed capital formation. However, government final consumption expenditure saw a lukewarm growth of 1.3% year over year. Coming to the sector-wise GVA breakup, the services sector posted strong growth contributed by revival in trade, hotel, transport, and communication. However, the growth of mining, manufacturing, and electricity fell short, which shows that high commodity prices had an impact on producers' margins. The key takeaways from the Q1 data is while the growth was slower than expected, the Indian economic recovery was broad-based, with all the sectors crossing the pre-pandemic levels. The momentum in consumption and rebound in services sector have been strong positive for the economy. Going forward, we believe further improvement in consumption, decline in commodity prices, government's continued focus on capital expenditure, and improved agricultural growth will support GDP. Having said that, if India does need to grow at a sustainable annual rate of 6 to 7%, we do need more policy efforts and favorable global macro conditions. The 8 core industries output growth for July 2022 came in at 4.5%, much lower than the 13.2% output growth seen in June. Let's understand why. The core sector is an index of the 8 most fundamental sectors of the Indian economy. These sectors have significant links with other industries and therefore have a strong impact on the Indian economy. The slow growth of 4.5% can be attributed to normalization of the base effect. However, when we compare with the pre-pandemic month of July 2019, output in the 8 vital sectors grew 6.1%. This indicates continued improvement in our core sectors. On a year-over-year basis, only 2 sectors, crude oil and natural gas, witnessed a slowdown, while all the sectors have recorded a growth. Sequentially, the index contracted by 2.3%, with coal, refinery products, cement, and electricity seeing a sequential decline. In spite of continued global challenges, India's economic activity has held up pretty well as measured by the output of its core sectors. The performance of most of the core sectors have improved. Now, the recent decline in global commodity prices will also support the outlook for the core sectors in the near term. Now that we've looked at the GDP and core sector output numbers, let's look at how the central government's finances are shaping up. Now, fiscal deficit is the difference between total expenditure and revenue of the government. In other words, it is a shortfall in government's income compared with the spending. The fiscal deficit stood at Rs 3.41 lakh crore in April to July period, accounting for 20.5% of the full year target. The fiscal deficit narrowed from 21.3% reported in the comparable year earlier period. On a very encouraging and positive note, July is also the first time in 28 months that the centre has posted a fiscal surplus. This is only possible on the back of strong tax revenues. When we look at this chart, tax revenues have been robust with record high GST revenues. On the expenditure side, government has incurred higher capital expenditure, which we believe is necessary for the growth of the Indian economy. So far, the centre's finances look in very good shape, with the fiscal deficit at only a fifth of the target at the end of the first 4 months of this fiscal year. We did believe that managing the expenditure side could get tough for the government in light of threats brought on by global uncertainties. However, the robust tax revenues will offset any higher than expected subsidy outlays and revenue losses brought on by excise duty reductions. So what does these news mean for you? India's Q1 data showed us that the recovery in Indian economy is on track, backed by momentum in private consumption and rebound in services sector. This will have an indirect positive impact on you. Despite challenges, strong growth in core sectors in July is an indication of Indian economy being on track. This will have an indirect positive impact on you. Despite again the current macroeconomic headwinds, the government finances seem to be in order on the back of strong revenue collections. This will have an indirect positive impact on you. While I say this is me, Merlin Susanna, signing off. Take care and stay invested.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.